This video is going to be a look back to one of the earliest videos on this channel, published on May 18th, 2021, where a prominent economist, Nouriel Roubini, is putting forth a pessimistic prediction saying that the Fed is cornered, will either lose control of inflation or crash markets. And now, more than 3 years later, neither has happened. And I'm going to take the entire footage of this video as part of this new video that you're watching right now to see about how I was correct and these formal economists were wrong. So it's part of my inflation victory lap series. So on to the footage. Greetings. The difficulty level of this video is easy, and today we're going to look at another example of an expert talking head who comes on various financial news programs and likes to pontificate about how the Federal Reserve has caused a situation that is going to cause inflation any day now, any day now. They've been wrong for years and years and years at a time, and they still think inflation is just around the corner. It's actually become almost sort of a weird little cult here of people who insist inflation is about to happen tomorrow, even though they've predicted about 100 of the last 0 bouts of high inflation. The expert in question over here, Nouriel Roubini, is someone who is always a perma-bear. His nickname is Dr. Doom. He tends to say that things are about to go bad, and therefore 3 years before the financial crisis, he said there will eventually be a recession. He was kind of right about that. The real estate bubble could not sustain a rise in interest rates. It was a pretty easy prediction. I too predicted that on The Futurist even before he did. But on account of being someone who's a perma-bear, eventually he's right whenever there is a recession, and that kind of made him famous, and therefore he is out again talking about, oh, interest rates will rise and there will soon be inflation. But if you watch this channel, you know how quantitative easing from the Federal Reserve does not cause inflation. And a number of outdated assumptions for what he says are what we are going to examine and deconstruct in this channel. He, despite being an immigrant, still seems to act as though the United States is the only country in the world in terms of the Federal Reserve printing money is going to cause U.S. inflation, when we know that the entire world is borderless in terms of these metrics, commodity prices, inflation, and so forth. So this video is going to be yet another lesson about how assumptions that economists have are completely outdated. They are intellectually unequipped to, frankly, just understand the economics of technology and more specifically software, where you don't run out of supply and there's no such thing as a supply bottleneck. So we will proceed with this video here.
Well, who better to ask than the man who warned us about the financial crisis of 2008, 3 years before it happened? Internationally acclaimed economist Nouriel Roubini. Nouriel, it is great to have you with us here on Kitco today.
Great pleasure being with you today, Michelle.
Okay, so we have this unprecedented stimulus, helicopter money, record low rates, and the Fed is saying that inflation will be transitory and claims that it can be controlled. So how does this play out?
Well, my concern is that while in the short term, inflationary pressures are still limited, the rise in inflation we're going to see this year is not going to be just transitory and driven by a base effect, but it could be more persistent over time. Why? After this COVID crisis, we had a massive amount of monetary fiscal stimulus and credit easing, $3 trillion of stimulus last year, 900 last December, 1.9 trillion just passed, and now 4 trillion plus of various types of infrastructure spending that may be passed by Congress. This is a time when the economy is already starting to grow faster and improving than previously expected. So it looks like the stimulus, one, is excessive. Two, it's the supply bottlenecks. We're seeing semiconductor, pharma products, commodities, and so on. So we are now surging demand because there was a build-up of savings built also by the transfers of the government. There's pent-up demand, and there is now constraints on supply. And that implies that inflation over time may go much higher than the Fed expects. The other concern I have is that not in the short term, but over time, we can go back to not only inflation, but also to stagflation. What is stagflation? Is it a situation of low economic growth, if not negative, and rising inflation. Now, last time we had seen it was in the 1970s. This time around, most likely, unless there was a war between US and Iran, the negative supply shock is not going to be driven by oil, but there are other factors that suggest that there could be a reduction in potential growth and a rise in cost of production with a negative supply shocks. And if you monetize fiscal deficits in that context, you may end up with inflation and stagflation. Now, what are they? We have now deglobalization, fragmentation of the global economy, balkanization of global supply chain, reshoring of foreign direct investment from China to high-cost regions like US and Europe. We have import protection, we have restriction to trade in goods, in services, in labor, in capital, restriction to migration. We have this decoupling between US and China on trade, technology, data, information. We have now also a declining in the supply of labor because US, Europe, Japan, advanced economies are aging, but not only advanced economies are aging, but now China, Russia, Korea, and other Asian countries are also aging. And you add to it also now policies that are going to be progressive to try to redistribute income from capital to labor, because labor has been disadvantaged for the last few decades. And that can lead to a build-up of wage and price pressures and reducing potential growth, increasing the cost of production, then you monetize large fiscal deficits, and down the line, I'm not speaking about this year, but 2 years down the line, we could also end up into stagflation, recession, and inflation, like in the 70s. That's a rising risk.
Well, many are sharing that outlook, particularly when you look at the Biden administration's agenda, and it seems to go very, very big on spend.
Okay, we'll stop right there. He's all over the place on the factors he's throwing out. And remember, when someone earns a living about being a pessimist and then they get accolades whenever something bad happens and they happen to be right somewhat by chance rather than through a precision of their predictions, then they have a certain set of tools in their toolbox. He spoke about shrinking workforce because of aging population, and therefore wages rise, which is a bad thing. I mean, remember, only these PhD economists will say wages rising is a bad thing, and they often say things like too many people have jobs. But isn't such a belief mutually exclusive with the fear that automation is taking away jobs? How can you simultaneously have a narrative saying that wage pressure is rising because of a shrinking workforce and an aging workforce, but automation is taking away jobs, so that's bad? These are where these contradictory sound bites tend to be very problematic and not very well thought through. Now, of course, he didn't mention automation, to be fair, but he's also throwing all kinds of things out there about supply bottlenecks and so forth, and how we had stagflation in the 1970s. No recognition whatsoever on his part of how different the economy is from the 1970s. Now we have a lot of software in the economy. A lot of hard goods are also produced by software. This is the big cushioning effect that not only moderates things that could cause inflation, but also contributes to deflation. There's no supply bottlenecks in software. And as you know, if you've watched other videos on this channel, the high-tech fracture of the economy is now 3% of world total GDP. And it was only 0.5% in 2000 and certainly negligible in the 1970s and 80s. And therefore, he's really just repeating some boilerplate textbook material from 1970s and 1980s era textbooks. Now, he's right that bad policies can cause inflation, but at the same time, he's taking a very domestic view on that. And the United States is the largest economy in the world, but bad policies cannot cause as much inflation at the global level, and we're still not at a point where this is a meaningful risk. So we continue.
I think that's exactly the reality we're facing right now. We're in a situation in which eventually the stimulus might be excessive. Eventually, inflation may raise too much. At the time where the Fed is telling us, I'm not even thinking about start tapering, and maybe tapering will start only next year. And the Fed forecasts are that the first rate hike away from zero is going to occur only sometime in 2024, that is 3 years from now. So we're going to be with zero rate for another 3 years at the time where the economy by the end of the year might be at full employment. It's clear that the Fed is now locked itself in a corner because they're saying the increasing inflation is temporary.
Okay, we'll stop there. Here's the problem with a lot of economists. They are so theoretical that they actually say things that are very, very unsympathetic to the human condition, saying things like full employment, and other economists, not Nouriel Roubini right here, but it's a very common thing among other economists to say too many people have jobs. Why? Because if too many people have jobs, there might someday be some inflation somewhere. No mention of why that is worse than fewer people having jobs. No recognition, even from what Nouriel Roubini has said here, that deflation is in fact a bad thing and could happen. And what's telling is that even the Federal Reserve is slightly more forward-thinking than Nouriel Roubini, because they recognize that interest rates will have to be low for a while. Now, I've very openly said that the Fed's funds rate has to be zero permanently. It was zero since 2009, and they never should have temporarily raised it. I'm going to show you this chart from chapter 4 of my Atom publication. You can see how when the Fed funds rate was zero, it should have stayed zero forever because quantitative easing was already being done. This was the age of money printing, the age of technological deflation. This weird need to increase it, and they have a belief that the normal interest rate should be 3% and unemployment rate should be X because otherwise too many people have jobs and cause inflation, backfired on them. There was a huge stock market correction and they were forced to lower it down lower and eventually to zero. And they went all the way from 1.75% to zero on March 15th, 2020, which I very prominently called out as the Netscape moment of economics. That was a day from which permanent QE became more normalized, as well as need for the Fed funds rate to be zero became more normalized. Now, the Federal Reserve doesn't recognize that the Fed funds rate has to be zero forever. Nouriel Roubini is even more resistant to that because his fame was from predicting a real estate crash back before the age of quantitative easing, so he doesn't understand how the economy has changed. But March 15, 2020 was the Netscape moment of economics, and the Fed funds rate will stay at zero forever, which is a very good thing. These PhD economists are still years from figuring out, but Nouriel Roubini is even further away from the Federal Reserve, which is really saying something. Now, back to the video.
I want the inflation to be above target for a while to make up for inflation being below target. I want the economy to become and the labor market a little bit hot because now I care about inclusive employment, meaning about inequality. All of this means to remain dovish for a long time when maybe the factors that are going to lead to a rise in inflation are not going to be only temporary, transitory base effects, but because of the stimulus, because of the imbalance between demand and supply, they may be more persistent over time. So that's the risk we're facing.
Okay, so Nouriel, then the Fed has backed itself into a corner, as you say, it's trapped. What happens? How does this play out then?
Well, if in the next few months the increase in inflation were to be truly temporary, then the Fed would be right. That would happen if most of the stimulus is saved rather than spent and used to run down arrears and debt. But if instead there is this huge amount of savings and pent-up demand.
So at least he recognized that the Fed seems to think that inflation is temporary because it will only be a recovery back to pre-COVID levels. But now he's talking about sustained demand from too much stimulus and too many people having jobs and how that can cause inflation.
And also, then the increase in inflation is going to become more persistent. And then the risk is really that the Fed is behind the curve. Because either the Fed at that point keeps on saying things are temporary, inflation starts to rise, inflation expectations start to rise, they control the short end of the yield curve, but then long rates can rise in nominal and real terms. That's one risk. Then inflation gets out of control. Either you are behind the curve, you're going to cause inflation, or you don't want to be anymore behind the curve, and then you signal it an item, then you could have a bond market and a credit market crash that could really weaken the economy, not start it. So then if you do it, then if you don't.
So there you have it. When all somebody knows is that inflation can happen if there's full employment or if too many people have jobs, then there are supply bottlenecks because there's no such thing as software that can never have a supply shortage. And inflation occurs, and you've been trained that inflation is always bad and never once even utter the word deflation. And you're effectively just a broken record who got famous once because he was right about 2008, but now is pretty much just a one-trick pony. That's all he can keep doing. And nothing personal about Nouriel Roubini. All PhD economists say the same thing. They all have memorized the same textbooks. They all have the same cognitive blocks. They're intellectually and even holistically unequipped to understand how much the economy has changed through the diffusion of high technology. And they don't see the irony in predicting inflation. Even though quantitative easing has been going on for 11 years already, there's a very distinct gradient of how much quantitative easing can rise in proportion to the extent to which the economy becomes high-tech. And I've presented all those numbers over here, and the matchup is very solid and profound. But they just don't have the curiosity or framework to understand that because they could never believe why the economy of the 1970s is in any way different than the economy of today, or even how the economy of today is different than the economy of 2011, 10 years ago. We have continuously rising diffusion of software into the economy. Again, this is another PhD economist who does not have to make any rapid financial decisions in terms of managing money or anything like that, and was pretty much set for life based on getting lucky about having gone on record predicting the 2008 crisis, which was easy to predict. I predicted that too, and I have links in the description box about that as well. But all these people are still in very 1970s era thinking. So there you have it. You saw all of the statements that he made, my counter statements, and who turned out to be right in the end. Well, you can see this table of the CPI inflation rate, and you can take a 3-year or 5-year period to see those are slightly above the trend, but the last 2 years has been low, and certainly the last 1 year. So they had one speed bump, and then it defaulted back down to low inflation and is arguably drifting lower into deflation at this point. If you like this type of content, I encourage you to subscribe to this channel, and thank you very much for watching.